So hi, I'm Soumya. I'm the Our Ladies New York chapter founder. You can find us on ourladiesnyc.org. I'm an RN Finance committee member, so a little bit of finance interest. And I'm also a quantitative analyst in the public sector in financial regulation. And so let's keep talking. That's my email address. That's me on Twitter. I'll try to, if you have questions about stuff I've done or you have ideas on data sets or things you want to collaborate on, please come find me. Or critiques also. So when I first began interacting with the data science community, oh, I forgot to say something. The views today don't represent my employer, they're my own. Okay, when I first began interacting with the data science community in R back in 2015, three things became super, super obvious to me. One was I had a lot to learn, just a lot. And then there were new tools, packages, techniques that are being introduced constantly, which is incredibly overwhelming. Even during this conference, I think there are things that I've seen that I'm like, oh, I should learn how to do this. Okay. And then I also realized that these tools and packages and techniques could make my life way, way, way easier if only I found a way to efficiently learn how to use them and utilize them. Okay, so this obviously led to more questions and more thoughts. So one was, how do I continue to engage and build a strong skill set? How do I manage this while doing my day job? And how do I connect this back to my day job in quant finance, which is not exactly the same as data science, right? A little bit of a difference. So that's why I took the opportunity in this talk to kind of explain a little bit more about what I do, because I don't really share that very often. So when I was thinking about how to connect this and how to connect to the open source community, I did realize one thing, that I do read a lot of academic papers, and that requires a lot of stats and code. So I thought, hey, what's the easiest way that would be useful for something I do at work versus, and also useful to the community, it'd be to replicate what's in these academic papers. So why would one do that other than just like want to frustrate yourself? So one is to like actually have it for takeaways, right? To be able to read the material and really understand what it says. Understand, especially when you're looking at stats code or you're looking finance code, you want to look at the data, you want to see how accurate those results were, you want to see how accurate the methodology was. So it's really to understand that. And then you want to critically evaluate whether the methodology and technique can be extended to different frameworks, right? So because essentially, like a lot of the work I've done in the past has been in the space of systemic risks, so I want to be able to extend different methodologies in different places. So, and yeah, possibly one day maybe I would be able to contribute like so many of you here in the open source community. So today's topic is really systemic risk. Okay. So systemic risk is really, really important, and it's something that I know most people like hear and they're like, so boring. Okay. So basically, what happened? I mean, there've been many financial crises, but probably the one you guys most probably remember is from 2007, 2009, and it really emphasized the importance of systemic risk in the financial sector and how important it is for us to understand it as well as measure it. So there were some pretty significant landmark events at the time that were not limited to failures of Bear Stearns, Lehman Brothers, Fannie Mae, Freddie Mac, that kind of emphasized that bank runs are not really a joke, right? Like we should care about this. Okay, and there was also a tremendous cost of systemic risk because essentially we had to implement, all over the world had to implement policy. We had to have parts of the industry actually agree with this policy and follow the regulation. So it should be something that we care about. Okay, so really understanding, so what does it really mean, right? I mean, I gave you some idea of why, the context of it, but what does it mean? So ever since the crisis, it's been about 10 years from the crisis, there's been more of a collective focus on research in the systemic risk space. And so basically systemic risk, according to the hub, the Systemic Risk Hub, generally refers to the disruption of flow to financial services, and it also can be caused by an impairment to all of parts of the financial system, and it has the potential for super serious negative consequences, which we didn't really feel because our government stepped in, but it could have been really, really terrible. So, and the reason why this is happening is because some of these institutions are very, very big, and they're interconnected. So it's very hard to understand the ramifications as you see them speed along. So really the most fundamental or primary cause of systemic risk is banking crises. And to really understand what drives banking crises, you need to have a really good definition. So I pulled a definition from Levin and Valencia's 2013 paper that basically that a banking crisis meets two criteria. So one is basically that it has significant signs of financial distress in the system. So as in there are losses, or there are big bank runs, or bank liquidations, which is what we saw in 2007, 2009. And then there is significant banking policy intervention that's needed to actually stop the losses. So this is sort of like the main idea. And so to really understand the number of crises, here's sort of a graph from the IMF. They maintain an actual financial crises database from, I think, 1970 onwards. And so if you see, like in 2008, obviously there were many financial crises across the world. But in total, there have been 151 financial crises since 1970, which is kind of crazy. And so to really understand the cost of something like this, so if you look here, this actually only goes up to 2000 because they haven't, some of this data is kind of old, so they don't update this as frequently. But the financial crisis, if you look at this, it's pretty important because as a percent of GDP, it can add up to a lot. So you probably want to pay attention to why a financial crisis would happen and how maybe we can better prevent it or at least predict it so that we can be ready for it. The other part you probably want to focus on is sovereign default. So you really want to understand internationally what's happening and to see whether countries are defaulting on their own. So if you look, the right, the red is the actual amount of default, which if you see in 2008, 2009 was a little bit lower actually, but there were a lot of countries defaulting at that time. So I mean, it's just to really give you a framework of why banking crises are an important thing to pay attention to. Okay, so time to make some more sense of this. Yeah, so one of the results from the crises were to actually have policy implementation, right? So you have regulatory institutions that have been restructured by Dodd-Frank, if you guys have heard this in the news lately, in the United States. And then there's a single supervisory mechanism in Europe. And essentially these perform more macroprudential like policy and sort of watch over the system. There's also the Financial Stability Board and Basel, which oversee the global system. And there's been a lot more focus on having stress tests, which is, again, something you probably hear that's talked about in the news. And just to highlight that one of the things that have come out of the policy framework is something called Basel III, which is a global voluntary framework on bank capital adequacy, stress testing, and market liquidity risk. Okay? So it's basically a way for people to actually measure and understand what's going on and for the regulators to actually say, okay, well, you should hold this much on your books. So now, sufficiently bored? Okay. So the reason why this policy is actually super important is because in the last 10 years, because of this, we've actually started collecting data. For the first time, we have data on this stuff that we never had before, right? So it's meaningful. Okay, so the next step is to identify the scope of what I was trying to do. So just to remind you, I was trying to do some replication of academic papers. My topic was systemic risk, right? Okay, so I was trying to understand the systemic risk measures more clearly. And so the first thing I found, not the first thing, but one of the things that I found that I thought was interesting was this paper that came out about pitfalls in systemic risk scoring. And I'm not going to read every author's name, so it's there. Okay. So that's the focus of today's, like, what I'll show you. But if you're interested, there is a systemic risk efforts summary written by Robert Engel. It's out there. You can search for it. It's in the annual review of financial economics. So that gives you an update on how we're doing and how we're measuring things. Okay, so let's start with Basel III, right? So this is basically the set of international regulations developed by BIS to promote financial stability. And so basically this allows us to reduce the amount of damage that banks can cause in the system. So, and really only 30 firms are like actually designated as SIFIs across the world, right? So just so you understand like how big this is and how these are big firms that are actually marked this way. And so this, the score that they come up with in Basel is actually used for people to evaluate and tell banks how much money they need to hold on to. So that's why all this stuff is like, everything connects. It's not just the data, it's also the policy, and it's also, okay. So this systemic risk scoring methodology I implemented, and what I'm going to implement, and what was implemented in the paper, was actually just the official case, which is the BCBS and the Financial Stability Board official actual methodology. Now, it's mostly simple math, but I didn't see anything in our package that actually existed that already did this, so I thought it was interesting to try to replicate it. Okay, so just to give you an idea of what kind of scores I was replicating, so specifically there are 12 systemic risk scores that focus on 5 areas. So you have size, right, which is basically total exposures of a bank. Interconnectedness, which is you're trying to understand how if one bank fails, how does it spread? You have suitability, which is the difficulties if, how difficult it would be to replace the service of the bank. Complexity, which is again, the higher the cost, the higher you need to actually fix the bank. And then cross-judicial jurisdictional activity, which is banks with international activity, so then they can transmit shocks across countries. So all this is pretty important. So these were sort of the 5 areas, and each area had about 2 to 3 scores within it that had to be replicated. And so fortunately with this paper, they actually had collected a meaningful data set, because now we have data, I think, in this paper from 2014, 2015, 2016 that I could use to replicate and show the scores. So So the other part of this paper focused on actually challenging those systemic risk scores and looking for particular bias. So one of the things that the paper claimed was that there was actually bias towards more volatility, as in more volatile assets were kind of changing the scores, and that affects the banks, right? Or the banks or the large institutions, because essentially they would have to pay more, right? Or keep more on their books, essentially. So they don't want to have that happen. And so what I essentially ended up building was a custom package just for myself right now, because I'm still testing it. And I basically used the data sets that they had, which was they had 75 banks in the world. And then I think they had actually extended it to, because I had used the 2014, 2015, 2016 data, it was like 100 plus banks data that actually broke down each portion of the score. So I just updated that and sort of replicated the mathematics in the paper, which I don't think I have time to go over. Okay, so the packages I used, one was obviously tidyverse, because that's the easiest one to sort of format data. And none of these data sets are very, very big, so I tried to use some tidyquant to see if I could incorporate market data, but it's not really possible with this. And I used some outliers to see if there were any outliers in the data that I could find, but my time series is not that long, so it wasn't that great. The package I built, as you saw E-Rob's talk yesterday, she recommended using DevTools and use this. I had used that before, so thanks, E-Rob. And then for visualization, just for some general stuff, I used ggplot2. Okay, so just to show you what I was doing and what was the data actually. So here I had the size and the interconnectedness and all of the measures broken out, and this was the data that I had from 2014 to 2016. That I sort of looked at the distribution. So it's interesting because there's a lot of skew in size and interconnectedness up top that you see towards the right, which I thought was, like it kind of gives you an idea of maybe some of the bigger banks or some of the bigger institutions have that score. And then, so when you're actually calculating the final risk score, right? So there were 12 categories under, or 12 set of scores under 5 categories that you were collecting. When you added all that up, you actually created like an actual score that was very important. And that would designate what a SIFI is, and that would designate the charge that the SIFI would face. So in this case, it was 130 and above. And so you can see that, the number of banks that actually face that, the actual rank of the bank, and you can see that there are 19 SIFIs that actually pass that number. So as in they are the highest score. So they would face the highest capital charge. So I didn't feel like showing you as many tables that matched up, basically. So I thought I would show you this instead, which I was successful in recreating what the methodology was. So other than just showing you matching tables, because the math was fairly straightforward. But one of the cool things that I did get through work through this was to really understand the methodology as well as the data set that the folks were using, because this data is not really, this is not a mature data set by any means, so there's a lot of fudging that people do in academic work that you really need to work through. So I enjoyed that. And then the other packages I discovered in the systemic risk space, and I urge all of you to come up if you guys know more. So one was systemic risk, which was just an exploration of, I think they come up with trying to understand defaults, and it's through financial networks. And then there was the evaluator package, which I think does a lot of scenario design, which I think is very cool. I didn't play around too much with this. I just read some of the documentation. So other things I discovered. So I found a really cool, I don't know if all of you know about this, the really cool website called runmycode.org, where they actually submit finance papers with the data sets as well as the code. They use mostly MATLAB because they're really old school. So it was great to see some of that, although I had a harder time understanding the MATLAB code. But it was great to see how systemic risk research has improved over time. And then, of course, I also found the replication wiki page that has economics research that's replicated on it. So I thought that was interesting. I didn't get to explore that too much. I used run my code mostly. So lessons learned in this. One was that replicating this work was not as difficult as I thought it would be. When I remember when trying to read the paper, I was just like, oh my God, this is going to be a lot of work for me to try to understand this. But it actually was simpler. And it was incredibly valuable because it helped me understand the paper, and I can now use some of this work in my actual day job, which I'm not discussing here. Okay. So, and I also got to build a cool package, and I hope I can go to eRob's talk and make sure I'm doing all the right things in it. So future work and conclusions. I would like to explore more of the S-risk stuff that people have been putting together on capital shortfall. That's not something I've really gone into. And then I also want to find more interesting data sets on the financial crises. So if anyone comes across something more meaningful, I would love to use it. And really quickly, shout out to Jared for putting up an awesome conference this year and having so many R Ladies speaking. Kudos. Please come and visit us at R Ladies NYC. And R in Finance is next week. We're going to be covering more nerdy stuff like this. So if you're interested in coming, we still have it's all open, and the discount code is 11 on 11 for 11% off. Okay. Yeah, thank you.